Hello and welcome to Mosaic Financial Partners. I'm Leslie Van Zee, Marketing and Communications Manager for Mosaic. This is our monthly webinar series in which we provide you with educational webinars designed to provide you with information on topics important to your financial success. Today's topic is going to be tax implications around equity compensation, which means we're going to be talking about the type of stock options you might receive from your employer, and we'll talk to you about what they are, how they work, and most importantly, how they're taxed, because there's a lot of complication around this, and if you don't understand all the pitfalls, you might not actually end up getting your money's worth out of your options portfolio. On the webinar today, we do have everybody on mute right now, but please feel free to type in questions for us through the chat window on your GoToWebinar. I have a laptop set up here. I can check for your questions, and we'll bring them in as we see them, and then we also have some time set aside at the end to answer further questions you might have. Today's webinar is being recorded, and the recording will be available on our website at www.mosaicfp.com/events. You can also go on there and see past recordings of past webinars we've done and find out about what topics we have scheduled for the future. With us today we have Geoff Zimmerman. He is a certified financial planner, and he is a partner and senior advisor here at Mosaic, helping clients who are corporate executives manage their equity compensation portfolios. So thank you very much for joining us today, Geoff.
Glad to be here, Leslie.
Okay.
Thanks. Today we'll be talking a little bit about the key features of stock options. We'll talk about how much the options are worth. We had a couple of questions about how do you exercise your stock options, so we'll talk about that. We'll talk about different types of stock options, particularly non-qualified stock options, sometimes called non-statutory stock options, or sometimes just non-qualified options. And we'll also talk about a second type of option called incentive stock options. We'll talk a little bit about how the stock options are taxed and when. We'll get into a little bit of a taste of AMT, the alternative minimum tax, and some of the implications for stock options. We'll touch briefly on other types of equity compensation. We'll talk about red flags, and then we'll talk a little bit more about financial planning. Does that sound okay with you?
That sounds very good. To lead it off, could you share with us what are some of the key features of a stock option?
Sure. So some common features between all types of stock options are they all have a strike price, and that's the price at which you are allowed. A stock option basically allows you to buy typically company stock at a predetermined price, and that predetermined price is the strike price. They have a finite life, so there is an expiration date, and that's the date at which the options go away. They are no more. And typically the options that I've seen have either a 10-year life or a 7-year life, but all of this is spelled out in a person's stock option agreement. There is a vesting period, so usually when options are granted, you don't get to access them all at once. They're usually given to you in bits and pieces over a period of time. You know, typically it might be 25% vesting per year over 4 years, so after 4 years you have access to the full grant. The grant date is the date which the options are actually granted to you. We'll talk a little bit about a couple of concepts of value. One concept is intrinsic value, and it's also called the bargain element. And this is the difference at any point in time between the strike price of the option, the price at which you can actually buy the stock, and the current stock price. And if the current stock price is higher than the strike price, then there's an intrinsic value there, and that's the difference between the two. There's another concept in valuing options, which we'll get into, and this is the time value. Because the options give you the right to buy stock at a predetermined price for some period of time, even though an option might not be in the money, there might be a bargain element of 0, there's still a value associated with that option because there's a possibility that that stock could go up in price between grant date and when the option's exercised. And so there are some ways to calculate or to apply a value to that time. Does that all make sense?
It does. So like even if I haven't exercised it, the option has some value to it.
That's right. And even if the option, if the stock price hasn't moved from the grant date, that option still has value because it gives you the right to buy the stock at a predetermined price.
So I think you were going to show me an example of just like a very simple situation of a hypothetical stock.
So we'll talk about a hypothetical company, GMZ company. Those are my initials.
Yeah.
So GMZ company, we have Executive Joe who comes to work for me. When Executive Joe comes to work, Joe receives 10,000 options. The options are issued at $5 a share, which is the current stock price of GMZ company when Joe came and got his option grant. And Joe's going to vest in those options 25% per year over 4 years. So in my example here, every year on the anniversary date of those options, Joe has access to 2,500 of the 10,000 options. So after 4 years, then he's got access to all 10,000 options. And let's assume an expiration date 10 years after grant.
Okay, so he's got 10 years in which to make up his mind as to whether or not he's going to exercise these and actually get the stock.
That's right.
But he doesn't have to do it until he actually wants to.
That's right. So he has control over the timing of when he exercises the options, and that has some implications for realizing an income tax event.
Okay, and then using that, we were going to talk about the value. You were sharing with us already about the intrinsic value.
Now let's do a hypothetical. So let's say now it's 2 years in the future.
Right.
Joe came to work for me. He got his option grant at $5 per share. And let's say over the past 2 years, the GMZ stock has doubled from 5 to 10. So now Joe he's 2 years in, and we said 25% vesting per year. So half of the 10,000 options are vested, so 5,000 options are vested. The current stock price at 10 minus the grant price of 5, so each of those options is $5 a share in the money. So in order to compute the intrinsic value of those 5,000 options, you take $10 a share minus 5, which is 5, multiply by the 5,000 vested options, and Joe now has the opportunity to collect, call it a paycheck, of $25,000 less taxes. We talked about intrinsic value, so what are those worth from a very tangible point of view? Well, we said with the current stock price of 10 and the strike price of 5, that those options are $5 a share in the money.
Right.
And if you take that $5 a share in the money times 5,000 vested options, then Joe has the opportunity to collect $25,000 worth of stock.
Right. So it's like having a
Actually, technically, he can pick up $50,000 worth of stock for a $25,000 outlay, if we really want to be technical about it.
Right. So he's got like a kind of like a half-off discount that he gets to use.
Yeah.
If he wants to.
Yeah.
Okay. And so that was our calculation right there. You take, so your intrinsic value is the number of shares that are vested right now.
Correct.
Because the unvested part doesn't have any intrinsic value.
Right.
And
they do, but he doesn't have any access to it.
He doesn't have access to it. Okay. And then it's the current price minus the grant price. So here we've got $25,000. Great. So, but there's another type of value that can apply to this, and that was the time value you were saying.
That's correct.
So.
And that's a very intangible calculation. There's a couple of ways to do it, and I'll throw out a little jargon. Black-Scholes is a method for calculating a value of an option during its lifetime. To take into the account the fact that based on the volatility of the stock, that option could be worth something or could be worth more than the current value during its lifetime. And so I don't want to go into the technical details of it, but Black-Scholes is one way to apply a value to this time value. Another is binomial lattice, and that's probably all I want to say about that at this point.
I think that's fine with me.
It's just a way to quantify, how much is this option worth more than just the intrinsic value.
Now, I don't want to go too into this because I know we're going to touch on this again later on in the discussion here, but we're talking about the time value, and I'm thinking, I can't sell these options to somebody as options, right? They're only mine to either use or not use, right?
Generally not, no.
So having an intrinsic value, there is a benefit to knowing that intrinsic value other than just being able to sell the option.
Yeah.
Which is something we're going to come back to.
Yeah.
Later when we talk about the financial planning aspect of this.
Yes.
Okay. So, but I just wanted to make that comment there. So, how do we exercise our options?
Okay. So, how do we exercise the option? Generally, and the technicalities, usually the options are set up with a company to execute through a brokerage firm.
Okay.
E-Trade is very common. Schwab does some work for folks. JP Morgan, Morgan Stanley, so on and so forth. But ultimately, the optionee, assuming they're not restricted from doing any exercises, because they're subject to trading windows, which we'll talk about later, basically says, I would like to exercise my option. And from a very, very fundamental point of view, what they need to do is they need to pay the purchase price. So at $5 a share times 5,000 shares, they need to come up with $25,000 to buy the stock. And then that's going to create a tax event. And the tax event depends on the type of option, but fundamentally, they're buying the option, and then they receive the stock.
Right. And
then they can do something with that stock.
Okay. And do they have a choice over what brokerage, or is it it's whatever brokerage?
It's usually the one selected by the company in that case, or with the company directly.
Okay. So I can, at the time I'm going to exercise it, I'm going to have to pay the money right there.
Yes, indeed.
And so there's several strategies, and you want to share with us how those different strategies are.
Sure. So common ways to actually exercise the option is to come up with the cash, write a check to the company to pay for the exercise, and in the case of a non-qualified stock option, you're going to create a tax event at the time of exercise. And we'll talk about this in a bit, but essentially the difference between the strike price and the exercise price is taxed as compensation income. So in my example of GMZ Company, where Joe exercises 5,000 options of a non-qualified stock option, then that $25,000 bargain element is like a $25,000 paycheck. And the company is required to withhold all the payroll taxes, so federal income tax, state income tax, Social Security if you haven't exceeded the thresholds for the year, Medicare tax, so on and so forth, and send that off to the Treasury. And unfortunately, the Treasury won't accept stock from the company, so unless there's a way of the company having cash to cover those payroll taxes on behalf of the employee, then the employee, Joe, is going to have to write the check for the payroll taxes and give that to the company along with the payment for the stock.
So this is under the scenario where, like we're talking about one of the options, one of the ways to do this is if I exercise my options and I receive the stock and I just want to hold on to the stock.
Right.
So that's the exercise and hold method. But the drawback on that, you're saying, is that if I've got the stock, I better have other cash to pay all those taxes that are going to be due on it at the same time.
Well, that's right.
And then another one is the exercise and sell to cover.
Right. So companies generally realize that the employee might not be in a position to write a large check to cover the cost of exercise. So what they will often arrange is for a process called sell to cover, which is an immediate sale of enough stock so that the proceeds cover the exercise price and the payroll taxes.
Right.
And then the employee, Joe, gets to keep the remaining stock. And it's kind of important and useful to note that Joe's basis in this stock, in the case of a non-qualified stock option, so I'll use that disclaimer.
Oh, here we go.
is the exercise price, not the strike price.
Right.
So basically, Joe has received a paycheck. In our example, he's received it in stock, and that stock has basis, which is the exercise price.
Right. And we're going to talk about that more when we talk about non-qualified stock options.
We will talk about that in intricate detail.
Right. And then another option, of course, that another strategy people can do.
Is that a play on words?
I was trying to unconfuse things. So, is if I just want my cash right then, I can exercise and sell all of it. And so.
Yeah, a very common strategy, especially with non-qualified stock options, is to do a exercise and simultaneous sale. So it's basically Joe saying, exercise these options, immediately sell all of the stock, withhold money from those proceeds to cover the cost of exercise and the payroll taxes, and give me the money.
Right, and now you just let me have the money. I don't need to hold, $25,000 worth of, or $50,000 worth of GMZ stock at this point in my portfolio.
I would prefer to have my paycheck in cash, thank you very much.
Right, though we think GMZ has growth potential. So we've already started to kind of touch on this, but this is non-qualified stock options, and tell me why is it important to understand what a non-qualified stock option is?
It's primarily because of the tax treatment. There may be some other nuances relating to transferability of the option, and these are spelled out in the stock option agreement. But for our purposes today, we're really talking about the tax event upon exercise.
And this is just one of the types of stock options people are going to get.
That's right. Although they are for companies that issue options, these are by far and away the most common form of options these days.
Okay.
So, and I think I already mentioned it, but upon exercise, the difference between the strike price and the exercise price is taxed as compensation income, the same way a paycheck would be taxed.
Okay. And then we'd already talked about when you exercise it, you have to pay federal and state tax, as well as Social Security and Medicare tax.
Right. Social Security caps out right around, don't quote me on this, but right around $117,000 in income this year. So if your income is already in excess of that, then there wouldn't be any further Social Security withholding, but certainly federal, state, and Medicare. Okay. And if your compensation is high enough, the additional 0.9% payroll tax.
That's right. Okay. So if you're not getting a non-qualified stock option, what's the other main type you're getting?
The other type of stock option, and these were very, very common during the tech boom of the late 1990s, is an incentive stock option. And these have some preferential tax treatment in the tax code, but there's also some pitfalls associated with them. And so we probably want to go through this in some detail, but also a little bit slowly.
Okay.
Does that sound okay?
That sounds good. We're going to work through this piece by piece.
Okay. So an incentive stock option differs from a non-qualified stock option because, this is going to get technical, under the ordinary method of calculating taxes, the one that you're probably most familiar with, when you exercise an incentive stock option, that bargain element is not subject to tax.
Nice.
Wow.
Okay.
Pretty cool.
Right.
Pretty cool. The other key piece about incentive stock options is provided you hold the underlying stock to meet qualifying holding periods, and I'll describe those in a moment, then when you later sell the stock, you can recognize capital gains tax treatment, long-term capital gains tax treatment, and that's applied on the excess on the amount from the strike price to the sale price.
Right. So it becomes so it's not just that you don't have to pay the taxes right away, it's also that the rate of tax on a big portion of that is a much lower tax rate because capital gains taxes
generally are lower than ordinary income tax rates and compensation tax rates.
So that sounds pretty good.
So far. And you're probably asking, what's the catch?
But what is the catch?
The catch is, and I'm going to do a brief aside, I've got, I think, a great example for this.
Okay.
You've probably heard of the alternative minimum tax.
Right.
Okay. Do you know what it is?
What is the alternative minimum tax, Geoff?
So glad you asked. The alternative minimum tax is a parallel method for computing taxes.
Okay.
So it's not layered on top of the ordinary tax, even though it might look that way if you look at your tax form, but it's a completely separate calculation. It's kind of like for a layperson. I can either take the freeway to work or I can take surface streets.
Yeah.
Okay? There's two different ways of getting there, but I'm going to run into different things along the way. And so is the case between ordinary tax and alternative minimum tax. I'll loop back around, but the key to alternative minimum tax as it relates to incentive stock options is for the purposes of calculating the alternative minimum tax, you have to include some things that are not included in the ordinary tax calculation. And that bargain element upon the exercise of an incentive stock option is one of those items that you have to include as income when you compute the alternative minimum tax.
Right.
Okay, so that's a key difference.
So we were saying, oh, the great thing about an incentive stock option is that I don't have to pay the tax on that bargain element when I exercise.
And that's why I qualified it by saying under the ordinary method.
Right. But when I go back to recalculate my taxes to see if I am due to pay under AMT, it is included.
Right.
So.
Right. You have to include that as income in the AMT calculation. And so that can create some issues. And in fact, it did in the late 1990s, where you had a lot of holders of incentive stock options who exercised their options. They thought there was no tax due, and they thought, great, I'll hold the stock for meeting the qualifying holding periods, which we should talk about, and then I'll just sell it and get long-term capital gains. And they were very, very nastily surprised when the IRS tapped them on the shoulder and said, by the way, you owe us tax. And they said, what do you mean?
Right.
I mean, exercise an incentive stock option. They said, yes, but we did the alternative minimum tax calculation, and you ended up owing more under AMT, and so pay up.
Right.
And there were a lot of real bad outcomes that came from that.
Okay. And is this why we had put a point in here saying that the tax rate might depend on a variety of factors, and these are the factors we're talking about?
That's correct.
As whether or not you're going to end up owing AMT.
That's correct.
Right. And so you already touched on this. The next thing we're going to ask about on ISOs. You had mentioned there are some qualifying holding periods. So share with us what those are.
So in order to qualify for long-term capital gains treatments, there's 2 time periods that you need to be aware of. The first is you have to hold the stock for at least 2 years from the grant date.
Okay.
So the date that you're granted the options. If you exercise that option and then sell the stock before you hit that 2-year mark from grant, that would be a disqualifying disposition.
Okay.
The second one is and this is the one you might be more familiar with because it's the 1-year long-term capital gains rate. You have to hold the underlying stock for at least 1 year after the date that you exercise the option. So oftentimes the 2-year from date of grant isn't a big deal because of the vesting period. A lot of vesting doesn't start for at least a year, and so if you exercise the option on the date that you vest and then hold the stock for a year, then you've met the 2 years and you've met the 1 year. But sometimes that can get messed up, especially if there's been an acceleration in vesting of the options.
Right. So.
And that's a whole nother topic.
So yeah, which we'll actually talk about when we get into that red flags issue section on our talk. But what we're basically saying is under those 3 ways of selling options, if somebody exercises and holds, then they'll be able to meet those holding periods. But if they exercise and sell to cover, or they exercise and sell, then they're not necessarily going to meet those holding period requirements.
Well, that's correct. And if they exercise and sell to cover, then they have a partial disqualifying disposition on the stock that they've sold. And if they do a complete cash out where they do an exercise and simultaneous sale, they have disqualified all of those options.
Oh, great. Awesome. I mean, bummer.
Yeah, it can be okay. It depends.
So we had a best case scenario.
Yes.
On an ISO, just to illustrate this.
Okay, so this really is a best case scenario, and the best case doesn't often happen, especially in states like California, and I can go into the details why, but basically where you're more likely to attract the AMT.
Right.
So let's assume for the moment that you've worked with your tax professional and you're not going to be an AMT, and you've modeled this out. So you exercise, you get an option grant. It vests.
Right.
You exercise the option, and we're assuming this is an ISO.
Right.
You've exercised it because the stock price has gone up. Your CPA has told you, Leslie, it's okay to do this, you're not going to be an AMT.
Right.
You say, great, you write the check to cover the cost of the exercise, and on an ISO, if you're not an AMT, well, even if you are an AMT, there is no withholding of payroll taxes at the time of exercise. So you don't need to write the check to the employer to cover those taxes. Now, estimated taxes are a whole other thing, but we're assuming best case scenario. So you write the check for $25,000 to exercise your $50,000 worth of stock. You begin holding the stock. You hold the stock and meet the qualifying holding periods. So you've held it for a year from exercise and 2 years from grant, and then you sell the stock. Then you can sell the stock and receive long-term capital gains tax treatment.
Okay.
So that's a best case scenario.
That's the best case scenario.
Right. What could go wrong?
And that's what we said. Result is you get to treat it all as long-term capital gain, or treat the bargain element. So let's go into this the tax situation. So just to review, we've been talking about a little bit of this as we go along, but just to kind of review this. At the time that you grant the stock options are granted, do I owe any tax?
No.
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 And at the time that they vest, do I owe any tax at that point?
No.
And when I exercise the option, do I owe any tax?
Maybe.
Maybe, and that's because if it's an NQSO.
Non-qualified versus an incentive stock option.
Okay.
Yeah, and that first 2 points, that's one of the real nice things about stock options, is that you have control over the timing of when you recognize the tax event.
And then when I sell the stock,
Yes.
do I owe taxes?
Maybe.
Maybe.
Maybe. It depends, as we've talked about a number of factors. On a non-qualified stock option, you've exercised the option, you've paid the payroll taxes, and now you have a basis in the stock, which is the market value on the date that you exercised. And then if the stock appreciates from there, and then you sell the stock, yeah, you'll have a capital gain.
Right.
And that'll be either long-term or short-term, depending on your holding period. And yeah, you may have some taxes when that happens.
So, but we're all assuming that the stock is just going up and up and up and up. So
not always a good assumption, but
that
so
doesn't
far,
always
yes.
happen either. So
Under this parallel tax system, we already said that there's some items that need to be included as income that wouldn't normally be included as income under the ordinary calculation. And that bargain element on the exercise of an incentive stock option is one. There's also, under AMT, some itemized deductions that are called preference items that you can't use, that you have to essentially add back in. And a couple of these common ones would be state income taxes and property taxes. And for those of us folks who live in California, where we've got a high state income tax rate and we've got pretty valuable properties that we pay property taxes on, and these are some of the things that can also trigger the AMT.
okay.
So it's important to know about these preference items. And there are others. I'm using these are the common examples here.
Okay, so it's not, so AMT could actually affect quite a lot of people,
You can,
especially in California.
yeah, you can be an AMT without having exercised an incentive stock option at all.
That's right. Okay, so we're going to cover, so we've talked about NQSOs and ISOs, but that's not the only types of equity compensation that people might be running into. So we have some others. I've put this up on here if you want to.
Sure. So a couple of other common forms of equity compensation are stock appreciation rights.
Okay.
And if you understood the concept of a non-qualified stock option and a non-qualified stock option exercise, then stock appreciation rights are pretty simple. The main difference with a stock appreciation right is, unlike a non-qualified stock option, you can't write a check to receive the stock. You can only do either a cashless exercise, which is another name for a sell to cover, or you can do a complete cash out.
Okay.
So, but otherwise, the taxation and how they're structured is virtually the same as with a non-statutory or
Right.
non-qualified stock
Okay.
option.
And then another one, restricted stock units.
Yeah, so restricted stock and restricted stock units are becoming much more commonly issued by companies today over stock options. And basically, it's a grant of company stock. So GMZ Company grants you, Leslie, 10,000 shares of GMZ stock.
Right, rather than an option to buy stock.
Rather than an option. And we're going to say that you vest in 25% of these shares over the next 4 years. So a year from now, you get 2,500 shares. A year from that, you get another 2,500 shares. And it's kind of your call as to whether you keep the shares or not. The key there is that you have no control, or virtually no control, over the taxation of those. And so when those shares vest, then you create compensation or payroll taxes based on the market value of the shares that vest when they vest.
So it would be like you're automatically exercised at the, it would be like an NQSO that automatically exercises
Yes.
on the vesting date.
Yes.
Okay.
Now the good news is that there's generally no expiration date associated with restricted stock. If you leave the company, then you generally lose out on the unvested shares. But there's none of this 7-year window or 10-year window or some of the other things that we go into with stock options. The other thing that by far and away, most of the companies that I've seen, the people that I've worked with, at the time the stock vests, the companies will sell enough shares to cover the tax liability and then issue the remaining shares to the employee, you, and then it's your call from there whether you keep the remaining shares or whether you sell the shares.
Okay.
And then your basis is the market value on the date of vest.
Okay, great. And then we have performance share grants.
Yeah, those are kind of an interesting animal. I haven't run into a lot of these, but it's basically similar in that it's usually an option or a grant that has some value, but the value isn't determined necessarily by the stock price. It's determined more by the operating results of the corporation.
Oh, interesting.
Yeah.
Okay.
So I haven't seen a lot of those. I think I've seen a handful or so. Yeah, and typically in the upper echelons of management.
Okay. So it's tied more towards the actual results on the company side than just the market's impression of what the company is doing.
Right.
Okay. Eligibility for employee stock purchase plans.
Yeah, so an employee stock purchase plan, and I want to distinguish this from an employee stock ownership plan, which is something completely different.
Okay.
An employee stock purchase plan is offered by the company and gives you, Leslie, the employee, the right to buy stock in the company. Now, years ago when I was at Schwab, for example, there was no discount. We could go in and buy shares, and there was, and it was pretty straightforward. We could buy shares at market value. A number of companies, and particularly I've seen a lot of these in the tech areas, they are allowed to offer up to a 15% discount on the purchase of their shares. So there's usually an enrollment period. The employee arranges to have money withheld from their paycheck, which the company sets aside in escrow. There is the purchase of the shares at a discount to the stock price. And I've seen them where they offer a discount off the price either at the beginning of the offering period or the end of the offering period, whichever is lower. And then the company buys, or the employee buys the stock at the discounted price and receives the shares.
Discount, is the discount taxable? The way?
Not immediately.
Okay.
But here's where we get into some fairly esoteric treatment, which is, and it's kind of like an incentive stock option. There's holding periods. If you meet certain holding periods, then you can get some favorable capital gains treatment.
Okay.
And if you don't, then you have a disqualifying disposition. So let's leave it there. Because then we start to get into a little more complexity.
Right. So this is one of those areas where if you're sitting there and you have one of these, not a bad idea to talk with a consult with your tax professional or your financial advisor.
Or preferably both. Hopefully your financial advisor is talking with your CPA and you're all meeting together to go through some of these issues, because there is some interaction.
Okay. So this brings us to the exciting portion, which is what are some red flags that people really need to be aware of that are also times when, speaking of red flags, we've got a fire truck going on outside. So these red flags are times when somebody really needs to go back and talk with a professional about their situation because they might be running into things.
Yeah, so there are some things that people need to be aware of.
So the first one we're going to talk about was acceleration of the expiration on somebody's departure from a company.
That's right. So it's very important, if you are considering changing jobs, for example, to pull out your option agreement and take a look to see what happens both to the vesting and the expiration date of the options when you leave.
Okay.
Generally, if an employee voluntarily leaves employment and they're not retiring or not leaving because they passed away, for example, vesting usually stops upon separation. And then there is usually a fairly finite period of time in which the now ex-employee can exercise those options.
So that what started out as a 10-year window to make up their mind about it, all of a sudden they've shortened it.
That's right. That's right. So it's important to be aware of those dates.
Okay. Another section here is ISOs and the danger zone.
Oh boy, here we go.
This goes back, this is talking about the AMT situation.
Right. So let me see if I can bring us back to our ISO situation.
So we'd gone over a best case scenario. So we're going to go over the worst case scenario.
Yeah. So we talked a little bit about exercising an incentive stock option and meeting qualifying holding periods. Okay? And if we didn't meet the qualifying holding periods and then sold the underlying stock, then we no longer get that possibility of no income tax on the bargain element at exercise. So, tangible example to try and make this clear. Let's say you, Leslie, have 5,000 incentive stock options that you received, you exercised them, you wrote the check to pay for the stock, and now you're holding the stock. And 3 months later, you change your mind and sell the stock.
Okay.
And let's further say for the moment that you're still not in alternative minimum tax. So let's talk about what happens there. What happens there is that you've had a disqualifying disposition.
Right, because I didn't meet my holding period.
And now that bargain element is now subject to tax as compensation income.
Right.
Okay? There's also a little bit of a problem, which is, remember I said the company didn't do any withholding at the time of exercise.
Right, because I was just going to hold it.
Right. So now you better get out your checkbook and consult with your CPA about maybe making some estimated tax payments.
Right.
Okay? But fundamentally, a disqualifying disposition of an incentive stock option, it's treated the same way as a non-qualified stock option. Here's where it gets really interesting.
Okay.
Let's say you've exercised your incentive stock option and you find that you're subject to the alternative minimum tax.
Okay.
Okay? And you find this out on January 2nd, so you've crossed the end of the calendar year. Okay? So it's important to note that at the end of the calendar year, you've locked in that AMT event.
Right.
You are now subject to it, and
I can't do anything about it anymore.
When your tax person gives you the bad news, you're on the hook. So do you say to yourself, aha, I need money to pay the alternative minimum tax. I wasn't expecting to do this. I know, I'll just sell some stock to get the money to pay the tax.
Right. Because I could have done that.
Because you could have done that.
When I exercised it.
You could have, but you didn't.
But I didn't.
So now you sell company stock to pay the tax, but you haven't held the stock long enough to meet the holding period requirements. Now you have a problem because you owe the alternative minimum tax for the prior year that was locked in, but now that option's treated as a non-qualified stock option, and now you owe compensation income on that bargain element for the current tax year. And this is kind of what happened at the end of the tech boom. You heard about some of the horror stories. People didn't think they were going to pay the tax or owe the tax. They exercised the incentive stock option. They were holding the stock. They crossed the end of the calendar year. Their tax professional said, by the way, Joe, you owe alternative minimum tax for that ISO exercise last year. The stocks were falling in value. Remember March of 2000? And Joe says, I know, I'll sell stock to cover the tax. And then they had a disqualifying disposition. So they ended up in a very, very bad place tax-wise.
Because then they owe it, and then they owe more. They want to sell some more, and then it's just
That's right. That's right.
ugly all around.
So fundamentally, and this kind of comes around to one of the things I like to say, the winter months, December, January, and February, generally are good times if you're going to consider an exercise and hold of an incentive stock option.
Why is that?
The reason is that in January and February, you exercise the ISO, you have all year to watch the stock, and as you get toward the end of the year, you can make the decision, am I going to do a disqualifying disposition, and that'll keep the tax as compensation income in the current year, or if you decide to keep the stock, you have a relatively short window of time that you have to continue holding the stock in the new year in order to reach the qualifying holding periods for long-term capital gains.
Right.
In December, it's a little bit different. In December, most of the income events for the year are known. So if we're meeting with the client and their CPA, we're looking at the income events, we may find that there is some room to
underneath
exercise.
Where right.
Where the ordinary tax is higher than the alternative minimum tax. And so there may be some room to exercise some incentive stock options to get close to, but not over that threshold. And so, this is a dance that you want to do with a partner. This is not a solo dance that you really want to do on your own. But fundamentally, the winter months are really good times to look at and consider incentive stock option exercises.
Right, because you have more time to control and you have more ability to work with that holding period window.
Correct.
Okay, great. So another red flag is what happens when there's accelerated vesting of an ISO.
I'm going to change that around and let's talk about some of the things that can trigger an accelerated vesting and what the implications are.
Okay.
So in many stock option agreements, and this applies to incentive stock options specifically.
Okay.
You're going to need a little bit of background, and that background is under the tax laws, only $100,000 of incentive stock options can vest in any given calendar year.
Okay.
Any more than that, and they're not an incentive stock option anymore.
Okay.
Okay. So, and that's based on the strike price times the number of shares vesting.
Okay.
Okay. So, for example, if you're granted 10,000, let's do 30,000 shares of GMZ Company at $5 a share.
Right.
And they're vesting at 25% per year, then you're not going to hit that 100,000 threshold.
Right.
So 30,000, 15, 7,500 times 5 is, whatever it is, $37,500 sort of thing. Option agreements often include a clause that under change of control of a company. So there's a merger, an acquisition of some kind, that unvested stock options vest immediately.
Okay.
Okay.
Because, hey, why make people wait for something that they can't get anymore?
Yeah, it's usually put in there as a safety valve. So what happens then in my example is all of a sudden you were vesting 7,500 shares per year over the next 4 years, and you weren't in danger of running over that 100,000 threshold. All of a sudden you've got 30,000 options vesting at once.
Right.
At our strike price of $5, that's $150,000 of options, and 50,000 of those then become non-qualified stock options. So
boom.
So, and the red flag to watch for, if that happens, is if you're exercising incentive stock options thinking that you're going to get preferential tax treatment, you may be rudely surprised if there's been an accelerated vesting and some of your options have converted to non-qualified options without you realizing it.
Right. There was one other red flag, and that's trading windows and regulatory filings for higher level corporate executives.
Right. So if you are a high-level corporate officer, and it kind of depends on the company, if you're CEO, CFO, Chief Operating Officer, Chief Information Officer, you are probably deemed to be a controlled officer, meaning you have continuing access to material non-public information. Even if you aren't, your company may impose trading windows, and I think they do this over at Google, where there are periods of time where an employee cannot trade in their company stock. Specifically, they can't be selling company stock. And so you want to be aware of these so you don't run afoul of your company and some of the SEC laws. And if you are deemed to be a control officer, then when you do transactions with your company stock or options, you have some regulatory filings that you need to do fairly quickly. I think that's about all I'm going to say on this subject for the moment, because that can go into some detail.
But I think the issue here was that because there's these periods of time that you have to be exercising and holding things, and you have also often there's a deadline in which you want to make the decision to exercise. When you layer in on top of that these trading windows, it can be very chancy to put things off to very late. So.
Well, right, and you raise a very good point, which is, we talked earlier about options and expiration dates. So let's say you've held that stock option for 9 years and 9 months. And expiration is coming up 3 months from now.
Right.
If you're subject to trading windows, you may find yourself in a situation where, holy smokes, my option's coming up on expiration, and I want to exercise this and sell the stock, but I can't.
Right.
And if you are still one of the worst things that can happen, and I've seen this happen once or twice, is you have an individual optionee holding a stock option that has intrinsic value. It's in the money, maybe deep in the money, and they get into a trading window, they can't sell the stock, and that option expires unexercised. Now, I have had a couple of executives tell me that it's okay to exercise the option to purchase the stock, but they can't do any selling.
Right.
And so what that means is then you have to come up with the money to be able to exercise the option and, if need be, pay the payroll taxes.
Right.
And so it's
to,
problematic.
Okay.
Think ahead. Try not to leave it till the last minute.
Right. So that the last area here is when you want to take some. When are you going to be taking some action of some kind? So there was.
Can I touch base on one more thing that that came across my mind? It's important to know, I think, if your company has any either explicit holding requirements for company stock, and if you're a high-level corporate executives, you probably do have that. I'm seeing that more and more common. You know, for fun, and this was about a year ago, I was reading through the proxy statement, the DEF 14A for Apple Company.
Okay.
And it's a regulatory filing with the SEC. I was doing this for fun. I have an odd life sometimes. But it was saying that Tim Cook, the CEO of Apple, is required to hold 5 times his salary in company stock.
Right.
And so it's important to be aware of any explicit requirements. Years ago when I worked at Wells Fargo, there was some requirement that you had to hold at least 50% of your stock from stock option exercises in the form of company stock, and if you didn't do that, there was some implication that that would affect future option grants.
Okay.
So it's important to be aware of any explicit requirements to hold the company stock. It's also important to be aware of any implicit requirements. And years ago, I was working with an executive from a tech firm that has now, you know, been acquired or merged with another company. But you know, there was an executive who was highly concentrated in their company stock, was about 2 years away from retirement, and had enough on paper in order to make that retirement transition. And we strongly advocated exercising options, getting that money off the table. The stock price was $40 a share at the time, you know, and begin to prepare for that transition to retirement. And he kind of shook his head and said, you know, Geoff, you don't understand. If I start exercising options, I will be cut out of the political loops within my company. So there was nothing explicit in the company documents that said, you know, don't do this or hold stock.
Yeah.
It was, oh, this guy's on his way out, and so, you know, we're going to push you to the backwaters, sort of thing. Unfortunately for him, the stock price dropped from 40 down to 16. His retirement became highly jeopardized, and then the company got acquired by another company.
Right.
And I don't know what happened to him after that. But the point is, it's important to be aware of any explicit or implicit restrictions regarding the holding or selling of company stock.
Good to know. Okay. So we had, let's see, the last section here we were going to talk about were some of the financial planning types of considerations. But up until now, we've been talking a lot about the tax side of things and what are you going to do to avoid problems with your taxes. But just now, you're starting to go into kind of like how does a financial planner look at this? And it's not just about how can you avoid taxes. It's also how can you avoid losses in this big source of wealth for a lot of executives.
Yeah. And in fact, I have an article up on mystockoptions.com that talks a little bit about holistic view of equity compensation, you know, which speaks to some of this. And really fundamentally what we're talking about is when do you, the option holder, need to or should strongly consider taking action? What are the factors that go into that? Well, the first one is your need for cash.
Yeah.
You know, if you've got a bunch of money sitting in company stock and non-qualified stock options, and you're buying a house next year and need money for a down payment, then how much of that do you want to jeopardize or leave you know, sort of to the whims and movements of the stock price? So cash needs starts to demand the timing of when to take action. Getting close to expiration is another, especially if there's trading windows. If your option has gone deep in the money, then it may be that there's not a lot of remaining upside and there's a lot of downside. You know, we sort of remember these financial events. 2008 is the big one that comes to mind. The tech meltdown is another. But even individual companies, and sort of think to MCI, WorldCom, and Enron, and countless other examples of the stock price is on up along in here. People are hanging on to their option. They don't want to incur the tax, and all of a sudden, for whatever reason, the stock price plummets, and those options either become much less valuable, or the stock price falls far enough that they go out of the money. The stock price goes below the strike price. And then if you've got an expiration event, then you've gone from having something to having nothing.
Yeah.
It's kind of like the old Steve Martin, how I turned $1 million in real estate into $29 cash sort of scenario. Not fun. So
that's where you do a leverage analysis to see whether or not there's any point to waiting to continue to hold on to the option.
Right. So a leverage analysis, and I'll briefly go through this, although when I start talking about second derivatives and things like that, most people sort of go, math, okay.
I'll stop you when we get there.
Okay. Think about an option, and in my example, GMZ Company, where I've granted you an option at $5 a share. And that stock right then is at $5. So that option has zero intrinsic value. It may have some time value. So let's say, and this is, call it 5,000 options, and let's say they vested immediately to keep all that fairly clean. That stock price goes up $1. So that stock price goes up 20%. 20% of 5 is $1. Stock price goes up $1. That option goes from having nothing to having $5,000 worth of value right then. And that rate of change is much more than 20%. In fact, it's almost infinite at that point. So now you're at $6. You've got $5,000 of value. The option's at $6. And the option goes up, or the stock goes up $1 more, so from 6 to 7. So that's roughly a 16% increase. From 6 to 7, it goes up $1. And that option goes from being $5,000 in the money to $10,000 in the money. It basically doubles in value. So for a 16% increase in stock price, you now have a 50%, I'm sorry, I lied, 100% increase. 100% increase in value. So still, huge leverage. As the stock price continues to climb, the option will continue to gain in value, but that rate of change, so it's very steep at the beginning, and then it starts to flatten out. So the rate of change declines. That's your second derivative for you math person. And so after a while, after that option's fairly deep in the money, then you're basically mirroring the change in stock price. There's still a little bit of leverage, but it's not so great as when that option is very shallowly in the money. And so, I think when the option has captured a sufficient amount of its leverage is when you want to think about harvesting it. Taking action, it's kind of like if I have fruit trees at home. I have a plum tree and an apple tree. If the fruit's green, you don't want to pull it off the tree. As it ripens, then you want to start to harvest it. You don't want to leave it on too long, because then it rots and turns bad. And kind of a similar principle with options. You want to capture enough of the leverage, and presumably you're looking at your other financial goals, your high-level goals, and the role that these options are playing. Harvest the options that are deep in the money that have captured most of their leverage, and leave the ones that aren't so deep in the money some time to mature. Does that make sense?
I think that makes plenty of sense. Another consideration is portfolio diversification.
So you as an employee, if you have a lot of stock grants or option grants, you may find that the performance of the company stock has very great and material influence over your financial future. Also taking into account that if you're working for the company, your paycheck and maybe even your benefits are all coming from the company. So you've got a lot of your financial life tied to the fortunes of the company. From a prudent management point of view, and I realize that for a variety of reasons, trading windows and holding requirements and things like that full diversification to the prudent person rule may not be immediately achievable. But generally at concentration levels above 20%, if an individual stock represents more than about 20% of the overall portfolio, then your portfolio performance is pretty much tied to the performance of the company stock.
Right.
And when we get higher level executives, we can see people with 50, 60, 70, even 80% concentration in their own company stock. So, diversification is we are strong advocates for diversification.
Absolutely.
And so that can be another reason to take action. You just need to tie your financial fortunes for yourself and your family a little bit further away from the company. And maybe not even the company. The company might be doing well, but the stock price is dependent on what the market is willing to pay for the stock. And if there's a disconnect between a company that's doing well and the actual stock price, then that can create a bad scenario. 2008 comes to mind.
Yeah. So there's market impacts, there's sector risk, all these other things.
There's all of that.
And I think we talked a lot about, I think we've touched enough on time until expiration and the potential impact of trading windows.
We talked about triggering events for taking action, which has to do with leverage and in the money value and cash needs and diversification and things like that. What action to take depends on the type of options that you have, for example. And if you're highly concentrated in company stock, if you're in a trading window, your goal is diversification or to need cash, you're probably exercising and selling those non-qualified options, unless you can't for some reason. If you're already highly concentrated in company stock, then putting up cash to buy more stock at the lower price just makes you even more concentrated. If it's an incentive stock option, we talked about the potential tax benefits. One needs to sort of weigh the benefits against the other factors, diversification, for example, reliance on the market for the company stock price, and so on and so forth. And the tax situation. So, what action to take as we get toward the end of the year, for example. And let's say this is a particularly high income year for you as an individual, and next year you're planning to change jobs or take time off or whatever it is and going to be in a low income year, then maybe there's a little bit of tax arbitrage, especially with the non-qualified options, to say, do I exercise this year? Gee, I'm already in the 39.6% federal bracket, I'm already in the 13% state income tax bracket, I'm being hit by, payroll taxes and Medicare taxes and so on and so forth, and maybe there's an opportunity to pull money off the table next year at a lower tax rate. I also, we didn't talk about this before, there can be an opportunity to use other programs the company offers, like non-qualified deferred compensation programs, in conjunction with option exercises to sort of stay tax neutral, achieve diversification, but that might be a subject for next time.
Sounds like a whole nother area to get into. And then timing of the actions you might take.
Yeah, so we touched a little bit on end of year planning, start of year planning, particularly important with incentive stock options, but even, as I mentioned a moment ago, the tax arbitrage between years, if your financial situation is going to be materially different from year to year. Planned departure. So if you're planning to leave, then note the expiration dates and any acceleration of those.
Right.
Also, if your options have not fully vested, or if they're still vesting, you might want to look at your departure date relative to vesting dates. It would be a real shame to leave the company, a day before 2,500 additional options vest, especially if there's some value there. So, take a look at that. Trading windows, we already talked about those, and there's probably other situations that we need to look at, but
okay, great.
These are the ones that come immediately to mind.
All right, well, I think that covers what we're going to do. Mitigation strategies for the red flags. So there was one question from Yaroslav that came in. So the red flags generally were acceleration of expiration on departure, ISOs in the danger zone, accelerated vesting of ISOs, and then the trading windows. Is there any particular things people can do to mitigate the problems that could happen with those?
Well, wasn't the question around tax mitigation, or was it general mitigation?
He just said mitigation. So.
Okay, so I'm going to make an assumption here. because mitigation, you probably as an employee, unless you're up in at the high managerial level, have no real control over whether your company is going to merge or be acquired by another company. So I think it's more of an awareness, and sort of a pay attention to your options and just don't leave them all until expiration. There was just sort of a brief story. This is a situation I heard of a while back, that a CEO of a private company decided he had a lot of incentive stock options, and he decided that he wanted to do an accelerated vesting. And he spoke with his legal counsel, and apparently they said, sure, why not? And so they did an accelerated vesting of the options, and then he found out after the fact that all of the options in excess of the 100,000 became non-qualified options. And said, that wasn't a good outcome, and I don't think it was a good outcome for his corporate counsel either. Usually when we talk about mitigation, we talk about ISOs and the danger zone, and what do you do about that? And I think the main thing to try to avoid is getting into a situation where you've exercised an incentive stock option, you've crossed the end of the calendar year, you're subject to the AMT, so you got in and there was no way to avoid it, and then it turns out you needed the cash to do something, and so you sell the stock and do a disqualifying disposition. The way to mitigate that is either don't sell the stock, which is difficult if you need the cash, or if the stock price is plummeting, and really it's do good year-end tax planning. Meet with your professionals, do the year-end stuff, and don't get into that situation in the first place. Yeah.
So be aware of the timing of these things and the things that could happen.
Yeah.
And do a little tax planning before the end of the year happens. So.
Definitely.
Yeah.
Definitely.
All right. And I don't see any other questions coming up. I want to thank you all very much for joining us today. We have, let's see.
Are we going to do another one of these?
We're going to do another one of these. November, I think the second Thursday in November, Liz Ravenko is going to be interviewing a specialist in property and casualty insurance, and that'll be a lot of fun because there's lots of stories that get involved in what happens when you don't have correct things in place about your property and casualty insurance. You can all view past webinars that we've done on our website at Mosaic, www.mosaicfp.com/events, and that would also be a good place to go to find out about upcoming webinars. And please also do follow us on Facebook and Twitter. We always appreciate having some additional followers on the social media channels as well. And that is it. Thank you very much.
Thanks for having me, Leslie.
Okay.